Question 1. An investment banking associate is tasked with valuing a private company using the discounted cash flow (DCF) method. Which of the following is the most appropriate starting point for the projection period cash flows? A. Net income. B. Earnings before interest, taxes, depreciation, and amortization, EBITDA. C. Free cash flow to firm, FCFF. D. Operating income. Answer: C. Free cash flow to firm, FCFF. The discounted cash flow, DCF, method aims to value a company based on the present value of its future cash flows. Free cash flow to firm, FCFF, represents the cash available to all capital providers, both debt and equity holders, after all operating expenses and necessary capital expenditures have been paid, making it the most appropriate measure to project when valuing the entire firm. Unlike EBITDA or net income, FCFF accounts for non-cash expenses like depreciation and capital investments essential for future growth, providing a truer picture of a company's financial flexibility. For example, if a company generates high net income but consistently spends heavily on new equipment, its FCFF might be low, indicating less true cash available. Remember, the DCF model values what a company can generate in cash, not just what it earns on paper. Question 2. During the negotiation phase of an M&A transaction, which document typically outlines the preliminary terms, conditions, and a non-binding framework for the proposed deal, including exclusivity periods and confidentiality agreements? A. Definitive agreement. B. Proxy statement. C. Letter of intent, LOI. D. Offering memorandum. Answer: C. Letter of intent, LOI. A letter of intent, LOI, is a foundational document in M&A transactions, serving as a non-binding agreement that outlines the key preliminary terms and conditions of a proposed acquisition. While not legally enforceable regarding the deal's completion, it typically includes binding provisions like exclusivity, which prevents the seller from negotiating with other parties for a specified period, and confidentiality agreements to protect sensitive information during due diligence. For instance, an LOI might state the proposed purchase price range, the form of consideration, and the timeline for closing, thereby setting the stage for more detailed negotiations. Think of the LOI as a handshake deal that gets the ball rolling toward a formal agreement, while protecting crucial aspects like information sharing. Question 3. A public company announces its intention to acquire another public company in an all-stock transaction. Which SEC filing is typically required to register the new shares being issued to the target company's shareholders and to provide detailed information about the transaction? A. Form 8-K. B. Schedule 13D. C. Form S-4. D. Schedule 14A. Answer: C. Form S-4. When a public company acquires another public company in an all-stock transaction, it must register the new shares being issued as consideration to the target company's shareholders with the SEC. Form S-4 is the specific registration statement used for business combination transactions, such as mergers, consolidations, and asset transfers, where securities are being offered as part of the consideration. It provides comprehensive information about both the acquiring and target companies, the terms of the transaction, and the financial impact on the combined entity. For example, if Company A is buying Company B using its own stock, Company A files an S-4 to register the stock it will give to Company B's shareholders, ensuring they receive full disclosure. Remember, the S-4 combines the registration statement with the proxy statement if shareholder votes are required from either party. Question 4. A technology startup is being acquired by a larger firm, and the deal includes an earn-out provision. Which of the following best describes the purpose of an earn-out in this context? A. It requires the acquirer to pay a fixed percentage of the target's future revenue to the seller. B. It provides for additional future payments to the seller contingent upon the achievement of specific post-acquisition performance milestones. C. It ensures that the target's shareholders receive a minimum return on their investment regardless of future performance. D. It allows the acquirer to claw back a portion of the purchase price if the target company underperforms. Answer: B. It provides for additional future payments to the seller contingent upon the achievement of specific post-acquisition performance milestones. An earn-out is a deal structuring mechanism where a portion of the purchase price is contingent upon the target company achieving specific financial or operational milestones after the acquisition closes. This structure is particularly common in acquisitions of private companies, like startups, where there might be a valuation gap between the buyer and seller or uncertainty about future performance. For instance, the seller might receive an additional payment if the acquired startup hits certain revenue targets or develops specific technology within a set timeframe post-acquisition. Earn-outs help bridge valuation disparities and incentivize the seller's continued involvement and success, aligning their interests with the buyer's post-deal. Question 5. In an initial public offering, IPO, the underwriting agreement may include a green shoe provision. Which of the following statements accurately describes the purpose of a green shoe clause? A. It allows the lead underwriter to purchase additional shares from the issuer to cover overallotments. B. It grants the issuer the right to buy back shares from the underwriters at the IPO price. C. It requires the underwriters to maintain a certain stock price for a specified period post-IPO. D. It provides a mechanism for investors to sell their shares back to the underwriting syndicate if the stock price declines. Answer: A. It allows the lead underwriter to purchase additional shares from the issuer to cover overallotments. A green shoe provision, formerly known as an overallotment option, is a standard clause in an underwriting agreement for an IPO. It grants the syndicate manager the right to sell up to 15% more shares than originally planned for the IPO. This option is exercised if demand for the shares is higher than anticipated, leading to an overallotment. The underwriter can then purchase these additional shares directly from the issuer at the IPO price to cover their short position created by the overallotment. For example, if 10 million shares are offered, the green shoe allows the underwriter to sell up to 1.5 million more shares and then buy them from the company to fulfill those orders, helping to stabilize the stock price post-IPO. Question 6. Under Regulation D Rule 506(c), an issuer can generally use general solicitation to offer securities, provided that a. All purchasers are accredited investors, and the issuer takes reasonable steps to verify their accredited status. B. The offering does not exceed $5 million within a 12-month period. C. The securities are offered only to institutional investors. D. The offering is registered with the SEC and a prospectus is provided to all investors. Answer: A. All purchasers are accredited investors, and the issuer takes reasonable steps to verify their accredited status. Regulation D Rule 506(c) allows issuers to engage in general solicitation and advertising for their private offerings, which is a significant departure from other private placement exemptions that prohibit such activities. However, this flexibility comes with a crucial condition: all purchasers of the securities must be accredited investors, and the issuer must take reasonable steps to verify this accredited status. For instance, a company might publicly advertise a new private fund, but before accepting any investment, it must meticulously verify each potential investor's income or net worth to ensure they meet the accredited investor definition. This rule enables broader marketing reach while still limiting the offering to sophisticated investors capable of assessing risk. Question 7. During the M&A due diligence phase, the buyer's team discovers that a significant portion of the target company's revenue relies on a single, long-term contract with a major customer. How should this discovery impact the buyer's assessment of the target? A. It strengthens the target's valuation due to guaranteed future revenue. B. It presents a concentration risk, potentially lowering the target's valuation or requiring deal restructuring. C. It indicates strong customer loyalty, making the target more attractive. D. It has no material impact, as long as the contract is legally binding. Answer: B. It presents a concentration risk, potentially lowering the target's valuation or requiring deal restructuring. During due diligence, discovering that a significant portion of a target company's revenue depends on a single customer highlights a major concentration risk. This means the target's financial stability is heavily reliant on that one customer relationship, and losing that customer could severely impact future revenues and profitability. Such a risk would typically lead the buyer to reassess the target's valuation, potentially reducing the offer price, or to consider deal structuring mechanisms like earnouts tied to the retention of that customer. For example, if a software company relies 70% on one large enterprise client, the buyer might worry about the contract's renewal or the client's own stability. Always look for diversification to mitigate business risk. Question 8. A board of directors engaged an investment bank to provide a fairness opinion in connection with a proposed merger. Which of the following is the primary purpose of this fairness opinion? A. To guarantee the financial success of the merger for shareholders. B. To certify that the transaction terms are fair from a financial point of view to the company's shareholders. C. To provide a binding valuation of the target company. D. To recommend whether shareholders should vote for or against the merger. Answer: B. To certify that the transaction terms are fair from a financial point of view to the company's shareholders. The primary purpose of a fairness opinion is to provide an independent financial assessment that the terms of a proposed transaction, such as a merger, acquisition, or sale, are fair from a financial point of view to the company's shareholders. It is an objective analysis conducted by an investment bank to help the board of directors fulfill its fiduciary duties and make an informed decision on behalf of shareholders. For example, a board might seek a fairness opinion to demonstrate to shareholders and potential legal challengers that they acted prudently and with due care in approving a deal. While it offers an opinion on fairness, it does not guarantee financial success or serve as a binding valuation. Question 9. Rule 14 times 10 to the power of -1 under the Securities Exchange Act of 1934 governs tender offers. Which of the following is a key requirement of this rule? A. The offer must remain open for at least 5 business days. B. All tendered shares must be accepted on a pro rata basis. C. The offer must be made to all security holders of the class of securities subject to the tender offer. D. A tender offer cannot be made for more than 20% of the target company's outstanding shares. Answer: C. The offer must be made to all security holders of the class of securities subject to the tender offer. Rule 14 times 10 to the power of -1, along with other rules like 14d, 1 through 14d, 9, governs tender offers and imposes several key requirements to protect investors. A critical principle is the all holders, best price rule, which dictates that a tender offer must be open to all holders of the class of securities subject to the offer, and all tendering shareholders must receive the highest price paid to any other tendering shareholder during the offer period. For instance, if a company makes a tender offer for its own stock, it cannot exclude certain shareholders or offer different prices to different shareholders. This ensures fair and equal treatment for all investors participating in the tender offer. The offer must also remain open for at least 20 business days, not 5. Question 10. In a Chapter 11 bankruptcy reorganization, which type of financing typically takes priority over all other claims, including pre-petition secured debt, to incentivize new lending to a distressed company? A. Debtor in possession, DIP, financing. B. Mezzanine debt. C. Subordinated bonds. D. Equity financing. Answer: A. Debtor in possession, DIP, financing. Debtor in possession, DIP, financing is a specialized form of financing provided to companies operating under Chapter 11 bankruptcy protection. Its purpose is to provide the distressed company with necessary liquidity to continue its operations, pay critical expenses, and fund its reorganization efforts during the bankruptcy process. To incentivize lenders to provide this critical financing, DIP loans are typically granted super priority status, meaning they take precedence over all other pre-petition claims, including secured creditors, in the event of liquidation. For example, a company might secure DIP financing to cover payroll and essential supplier payments while it develops its reorganization plan. This senior priority is crucial for encouraging new capital to flow into a high-risk situation. Question 11. Under FINRA Rule 5130, which of the following is considered a restricted person and generally prohibited from purchasing shares in an initial public offering, IPO, at the offering price? A. An investment advisor with discretionary authority over a client's account, provided the client is not a restricted person. B. An employee of a FINRA member firm. C. A general partner of a venture capital fund that is an institutional account. D. An employee of a publicly traded company that is not a FINRA member firm. Answer: B. An employee of a FINRA member firm. FINRA Rule 5130 aims to ensure that IPO shares are broadly distributed and not unfairly directed to individuals associated with the underwriting process or those in a position to influence the allocation. A restricted person is generally prohibited from purchasing IPO shares at the public offering price. This category includes, among others, employees of FINRA member firms, broker-dealers, their immediate family members, and certain fiduciaries to the managing underwriter. For instance, a registered representative working for an investment bank involved in an IPO cannot buy shares for their personal account in that IPO. The rule prevents spinning and free riding and promotes fairness in IPO allocations. Question 12. A private equity firm is evaluating a potential leveraged buyout, LBO, of a target company. Which of the following valuation metrics is typically of least importance in an LBO analysis, as the primary goal is often to maximize equity returns through debt reduction and operational improvements? A. Debt-to-EBITDA ratio. B. Internal rate of return, IRR, on equity. C. Enterprise value, EV/EBITDA multiple. D. Price-to-earnings, PE, ratio. Answer: D. Price-to-earnings, PE, ratio. In a leveraged buyout, LBO, analysis, the primary focus is on a target company's ability to generate sufficient cash flow to service and repay a significant amount of debt, thereby maximizing the equity return for the private equity sponsor. Therefore, cash flow-based metrics like debt-to-EBITDA and enterprise value, EV/EBITDA, are crucial for assessing debt capacity and valuation. The internal rate of return, IRR, on equity is the ultimate measure of the private equity firm's return. The price-to-earnings, PE, ratio, which is an equity valuation multiple based on net income, is typically of least importance in an LBO analysis because it doesn't directly reflect cash flow generation or the impact of leverage on the capital structure. For example, a company with high depreciation and capital expenditures might have low net income but strong EBITDA, making it an attractive LBO candidate despite a high PE. Question 13. An investment bank is advising a corporate client on a potential acquisition. The investment bank's private equity arm also owns a significant stake in the target company. What type of conflict of interest does this situation present, and how should it typically be managed? A. Information asymmetry, managed by creating a data room. B. Principal-agent conflict, managed by obtaining a fairness opinion. C. Buy-side/sell-side conflict, managed by disclosing the conflict and implementing information barriers. D. Material non-public information misuse, managed by refraining from the transaction. Answer: C. Buy-side/sell-side conflict, managed by disclosing the conflict and implementing information barriers. This situation presents a buy-side/sell-side conflict, also known as a dual-role conflict, where the investment bank has a financial interest in the target company, through its private equity arm, while simultaneously advising a client who wants to acquire that same target. This creates a potential conflict because the bank might be incentivized to push for a higher valuation for its private equity investment, potentially at the expense of its advisory client. To manage this, the bank must fully disclose the conflict to its client and typically implement strict information barriers, also known as Chinese walls, between the advisory team and the private equity team to prevent the sharing of material non-public information and ensure the advisory client's interests are prioritized. Question 14. Under the Securities Exchange Act of 1934, when a public company solicits proxies from its shareholders regarding a corporate action, example a merger or election of directors, which SEC filing is required to be distributed to shareholders? A. Form 10-K. B. Schedule 13-D. C. Schedule 14-A. D. Form S-1. Answer: C. Schedule 14-A. The Securities Exchange Act of 1934 governs the solicitation of proxies, which are authorizations given by shareholders to another party to vote their shares at a shareholder meeting. When a public company solicits proxies, whether for an annual meeting, example electing directors, or for a special meeting, example approving a merger, it is required to file and distribute a proxy statement, known as Schedule 14-A, to its shareholders. This document provides detailed information about the matters to be voted upon, the nominees for the board, and other relevant corporate information. For example, before a vote on a major acquisition, shareholders would receive a Schedule 14-A detailing the terms of the merger and its implications. Question 15. A non-U.S. company proposes to acquire a U.S. technology firm that develops critical infrastructure software. Which U.S. government committee is most likely to review this transaction for potential national security concerns? A. Federal Trade Commission, FTC. B. Department of Justice, DOJ. C. Committee on Foreign Investment in the United States, CFIUS. D. Securities and Exchange Commission, SEC. Answer: C. Committee on Foreign Investment in the United States, CFIUS. The Committee on Foreign Investment in the United States, CFIUS, is an interagency committee that reviews foreign investments in U.S. businesses for national security implications. When a foreign company seeks to acquire a U.S. firm, particularly one involved in critical infrastructure, critical technologies, or sensitive personal data, CFIUS has the authority to review the transaction and, if necessary, recommend that the President block or impose conditions on the deal. For example, if a foreign entity proposes to acquire a U.S. company that supplies technology to the Department of Defense, CFIUS would almost certainly launch a review to ensure no national security risks are posed. Question 16. A definitive agreement in an M&A transaction often includes deal protection mechanisms. Which of the following is an example of a no-shop provision? A. The target company agrees not to solicit or encourage third-party acquisition proposals once the definitive agreement is signed. B. The target company agrees to pay a breakup fee if the merger agreement is terminated under certain conditions. C. The acquirer agrees to match any superior offer received by the target. D. The target company has the right to actively solicit competing bids for a specified period after signing the definitive agreement. Answer: A. The target company agrees not to solicit or encourage third-party acquisition proposals once the definitive agreement is signed. A no-shop provision is a common deal protection mechanism included in definitive merger agreements, designed to provide certainty to the buyer that the seller will not actively seek out or entertain other acquisition proposals once the deal is signed. It generally prohibits the target company from soliciting, initiating, or encouraging alternative bids, although it may allow the target to engage with unsolicited superior proposals under certain circumstances, often referred to as a fiduciary out. For instance, once Company A signs a definitive agreement to buy Company B, the no-shop clause prevents Company B from actively looking for another buyer, protecting Company A's investment in the deal. Conversely, a go-shop provision allows the target to actively solicit competing bids for a limited period after signing. Question 17. In an equity underwriting syndicate, what is the primary role of a bookrunner or lead manager? A. To solely distribute shares to retail investors without taking on underwriting risk. B. To manage the entire offering process, including pricing, allocation, and stabilization. C. To provide research reports on the issuer after the offering is complete. D. To act as a passive investor, purchasing shares only if the offering is undersubscribed. Answer: B. To manage the entire offering process, including pricing, allocation, and stabilization. The book runner, or lead manager, in an equity underwriting syndicate plays the central and most significant role. Their responsibilities encompass managing the entire offering process, from advising the issuer on structuring and timing, to coordinating due diligence, marketing the offering, roadshow, determining the final pricing of the shares, allocating shares to investors, and potentially engaging in stabilization activities in the aftermarket. For example, in a large IPO, the bookrunner will be the primary contact for the issuer, guiding them through every step and ensuring the successful execution of the offering. They are the driving force behind the syndicate. Question 18. When a private company is being acquired, which of the following is generally not a requirement for the acquisition process, compared to a public company acquisition? A. Extensive SEC proxy filings and tender offer rules. B. Comprehensive financial and legal due diligence. C. Negotiation of a definitive purchase agreement. D. Valuation of the target company. Answer: A. Extensive SEC proxy filings and tender offer rules. Acquisitions of private companies are generally less regulated and involve fewer public disclosure requirements compared to acquiring a public company. While comprehensive due diligence, negotiation of a definitive purchase agreement, and valuation are essential steps in both public and private acquisitions, private deals typically do not trigger extensive SEC proxy filings, like Schedule 14A for shareholder votes, or rules governing tender offers, like Rule 14 times 10 to the power of -1. These regulations are primarily designed to protect public shareholders and ensure transparency in public markets. For instance, a private company sale involves direct negotiation between the buyer and private owners, without needing to seek votes from a dispersed public shareholder base or adhere to complex tender offer timelines. Question 19. A company facing financial distress is considering an exchange offer. Which of the following best describes an exchange offer in this context? A. Offering existing bondholders new equity shares in exchange for their outstanding debt. B. Issuing new debt to refinance existing debt at a lower interest rate. C. Selling a division of the company to another entity in exchange for cash. D. Offering new common stock to existing shareholders in exchange for preferred stock. Answer: A. Offering existing bondholders new equity shares in exchange for their outstanding debt. In the context of financial distress, an exchange offer is a restructuring tool where a company offers its existing debt holders, example bondholders, the opportunity to exchange their current debt securities for new securities, often a combination of new debt with different terms, equity, or a mix of both. A common distressed scenario involves offering existing bondholders new equity shares in exchange for their outstanding debt. This helps the company reduce its debt burden, lower interest payments, and improve its balance sheet without going through formal bankruptcy. For example, a company might offer bondholders 50% of the principal in new bonds and 50% in equity, effectively deleveraging the balance sheet and potentially allowing the company to avoid default. Question 20. Under the Hart-Scott-Rodino, HSR Act, parties to certain mergers, acquisitions, and other transactions are required to file pre-merger notification with the Federal Trade Commission, FTC, and the Department of Justice, DOJ. The primary purpose of this filing is to A. Register the securities being issued in the transaction. B. Obtain SEC approval for the merger. C. Allow antitrust agencies to review the transaction for potential anti-competitive effects before it closes. D. Publicly announce the proposed transaction to shareholders. Answer: C. Allow antitrust agencies to review the transaction for potential anti-competitive effects before it closes. The Hart-Scott-Rodino, HSR, Antitrust Improvements Act of 1976 requires parties to certain large mergers, acquisitions, and joint ventures to file pre-merger notification with the Federal Trade Commission, FTC, and the Department of Justice, DOJ, and observe a waiting period before closing the transaction. The primary purpose of this filing is to allow these antitrust agencies to review the proposed transaction for potential anti-competitive effects, such as a substantial lessening of competition or the creation of a monopoly, before it is consummated. For example, if two large companies in the same industry propose to merge, they must file an HSR notification so that the government can assess if the combined entity would unfairly dominate the market. This aims to protect consumer welfare and market competition. Question 21. FINRA Rule 5110 outlines regulations concerning underwriting compensation and due diligence expenses. Which of the following types of expenses are generally considered reimbursed expenses and are not typically considered underwriting compensation under this rule? A. Underwriters' counsel fees. B. Roadshow expenses. C. Printing costs for the prospectus. D. Promotional expenses for the offering. Answer: C. Printing costs for the prospectus. FINRA Rule 5110, Corporate Financing Rule, specifies what constitutes underwriting compensation in public offerings and what is considered a legitimate, reimbursed expense, not counted towards the underwriting compensation cap. Bona fide due diligence expenses, such as the costs associated with preparing the prospectus, including printing costs, are generally considered reimbursed expenses and are excluded from underwriting compensation calculations. These are viewed as necessary costs of the offering process. In contrast, items like underwriters' counsel fees, roadshow expenses, and promotional expenses are typically considered part of the underwriting compensation. It's about distinguishing between the legitimate costs of doing the deal and the fees paid to the underwriters. Question 22. In an M&A definitive agreement, a material adverse change (MAC) clause is included. Which of the following events would most likely allow a buyer to terminate a merger agreement under a typical MAC clause? A. A general decline in the stock market after the agreement is signed. B. The target company's stock price falls by 10% between signing and closing. C. A new regulation specifically targets the target company's core business, severely impacting its future profitability. D. The target company's quarterly earnings are slightly below analyst expectations but still profitable. Answer: C. A new regulation specifically targets the target company's core business, severely impacting its future profitability. A material adverse change (MAC) clause in a definitive agreement allows a buyer to terminate the deal if there is a significant, unforeseeable negative event that substantially impacts the target company's long-term earnings potential or financial condition. MAC clauses are typically narrowly construed and generally do not cover broad market downturns, industry-wide events, or minor fluctuations in performance. However, an event that specifically targets the target company's core business and severely impacts its future profitability, such as a highly specific and damaging new regulation, would most likely qualify. For example, if a new environmental law disproportionately affects only the target's unique manufacturing process, leading to unsustainable costs, a buyer could likely invoke the MAC clause. It must be truly material and specific to the target, not just general market noise. Question 23. An investment bank is advising a client on a private placement. The client is evaluating the appropriate discount rate for valuing the target company's projected free cash flows. Which of the following would be the most appropriate discount rate for valuing the entire company, both debt and equity? A. Cost of equity, COE. B. Weighted average cost of capital, WACC. C. Risk-free rate. D. Cost of debt, KD. Answer: B. Weighted average cost of capital, WACC. When valuing an entire company using the discounted cash flow, DCF, method, which considers cash flows available to all capital providers, both debt and equity, the appropriate discount rate is the weighted average cost of capital, WACC. WACC represents the average rate of return a company expects to pay to all its security holders, considering both debt and equity. It accounts for the proportion of debt and equity in the capital structure and the respective costs of each. For instance, if a company is financed by both bonds and common stock, WACC calculates the combined cost of attracting that capital. The cost of equity would be used for equity-specific cash flows, example dividends, while the risk-free rate is merely a component of other calculations. Question 24. A diversified industrial conglomerate decides to separate one of its non-core business divisions into a standalone public company by distributing shares of the new entity to its existing shareholders. This transaction is known as A. Reverse merger. B. Spin-off. C. Split-off. D. Tender offer. Answer: B. Spin-off. A spin-off is a corporate transaction where a parent company separates a division or subsidiary into a new, independent company. The shares of this new entity are then distributed pro rata to the existing shareholders of the parent company, who receive shares in both the parent and the newly spun-off company. This is done without paying any cash or other consideration to the parent. For example, if a large tech company decides to separate its cloud computing division, it might spin it off by distributing shares of the new cloud company to its current shareholders. The goal is often to unlock shareholder value by allowing each business to operate independently with its own management and focus. Question 25. Which of the following statements is true regarding a stapled financing package in an M&A auction process? A. It is a binding commitment from the seller's advisor to provide financing for the winning bidder. B. It is a prearranged financing package offered by the seller's M&A advisor to potential buyers, designed to streamline the bidding process. C. It requires the winning bidder to use the seller's existing lenders for their acquisition financing. D. It refers to the financing required by the seller to pay off its existing debt after the acquisition. Answer: B. It is a prearranged financing package offered by the seller's M&A advisor to potential buyers, designed to streamline the bidding process. A stapled financing package is a prearranged debt financing commitment offered by the seller's M&A advisor, often the same investment bank advising on the sale, to potential buyers in an auction process. This package is stapled to the sale of the company, meaning it comes with the target. Its purpose is to streamline the bidding process by providing bidders with a ready-made financing option, reducing financing risk, and potentially speeding up the closing of the deal. For example, in a competitive auction, the seller's bank might present interested buyers with a term sheet outlining the debt financing they could secure from that bank if they win the bid, making their offers more concrete and less contingent on securing external funding.